Okay, let's continue our discussion on the comparison of dividends and share repurchases. So recall that we had a firm which is called Jinrong Corporation. So this firm is trying to pay out $20 million in the excess cash to the shareholders. And we assume the firm is an all equity firm. And its equity cost of capital is 12%. And the firm expects to generate a future free cash flow of $48 million per year. So this cash flow will be generated per year forever. And then we talk about the first way of paying out cash. That is just pay out this cash using dividend. In that case, our task was to find out what is this firm's share price. So let's say we have this timeline here. And this is the X dividend date, which means if you hold this firm's share on this date or after this date, you won't be able to get this dividend. And then the valuation approach is actually quite simple. So we will just use the dividend discount model, right? We understand the firm will generate $48 million per year, and the firm has 10 million shares, right? So you can see that in the future, every year, the dividend would be equal to 48 divided by 10. Forever. And then obviously we can value the firm's share price using this dividend discount model, right? So share price on this X dividend date would be per year cash flow divided by the cost of equity. So this gives us 40. And then the firm will have a $2 dividend. So there will be a $2 dividend. So obviously the firm's share price before paying out this $2 dividend would be 40 plus 2. So it's 42, right? So our result is if the firm pays out dividend, then its share price will reduce exactly by the same amount as the dividend, right? Okay. Now let's talk about the second, right? So the second policy is to use share repurchase. So in this case, the firm will use this $20 million to repurchase its shares on the open market. So basically, the firm will pay this $20 million back to its shareholders, and the number of shares in the market will be smaller. Now, we would start with this basic result. That is, the firm's share price stays the same at $42. This is essentially a result from Proposition 1, right? Theorem basically says financial transaction does not create value or destroy value. So share price should stay the same, even if you use the money to make some repurchases. Again, we are in this perfect capital market, right? In this world with perfect capital market, share price will not change, even the firm pays out cash. So in this case, we can find, so the firm will repurchase 10 divided by share price, which is 42. Sorry, I should use 20 here because the firm has $20 million. So this gives us 0.476 million shares. Then number of shares left in the market would be the total number of shares minus number of shares purchased by the firm. So this gives us 9.524, right? And now we can value this firm's share by using these new numbers. Remember that we know the firm will generate $48 million per year. And now this firm has smaller number of shares. So again, we could use this smaller number of shares to calculate the firm's dividend in the future, right? So what we will do is, again, let's draw out the firm's timeline. So what I can see here is so let's find out the number here, right? The firm has $48 million and the number of shares is given by 9.524. So per year dividend would be given by this number. That is $48 million divided by 9.52, which gives us 4.04. So it's 4.04. Let me use a different color. So we will have 4.04 every year. And now, clearly, we could value these cash flows using this perpetuity formula, right? So the share price would be given by 5.04 divided by the cost of equity. So this gives us $42. So we can see that basically if the firm pays out this cash by using share repurchase, then we can verify that indeed the firm's share price after the repurchase should stay the same. It's still $42. So here you can see that the lecture note exactly gives you this calculation here. And we could also use this market value balance sheet to do this verification that the share price would be $42, right? So let's see. So in the beginning, the firm had $20 million of cash. And we know that the firm's share price was $42 and the firm has 10 million shares. So the total market value of the firm would be 420. And then we know that this is an all equity firm. So basically, the market value of the firm's asset equals the market value of the firm's equity. Because the market value of the firm's equity is 420. So obviously, the total market value of assets would be 420. So we could say the other assets have a value of 400. And next, the share repurchase will happen. So in this case, the firm will use the cash, the $20 million cash, to reduce the number of shares. So what you can see here is cash will disappear, right? It will drop to zero. And then number of shares will drop from $10 million from 10 million shares to 9.524 shares. And then you can verify that if you use 400 divided by the total number of shares in the market after the repurchase, then you will get the same number, right? So this is basically a second way to verify that share repurchase will still give you the same share price, $42. Okay, let's summarize this second policy. So basically, in a perfect capital market, a stock repurchase does not change the share price, and the share price would be the same as the common dividend price if a dividend were paid instead. So you can see here it says the same as the common dividend price, and we have calculated in the first policy, right? Remember, in the first policy, we calculated the common dividend price is 42. Right? So obviously, the share price after the repurchase is the same as the common dividend price. Okay, let's look at the third policy. So it's called high dividend. It's a peculiar policy because generally firms don't do this. But still, it's an interesting case in our lecture because we want to see what will happen under this third hypothetical case. So now let's say this firm wants to pay a high dividend, but you can see that the firm has only $20 million. So how this firm can pay a higher dividend? Well, you can see that the firm can do the following. It can raise the cash, right, by selling new shares. So we assume the firm will raise additional $28 million by selling new shares. In this case, the firm will have a total of $48 million in cash. And then the firm plans to pay out this $48 million in cash as dividends. I said this is a peculiar case because in reality, firms won't do this. A firm will not first issue new equities, then get cash, then pay out this cash as dividend. Firms won't do this. And in the near future, you will see why. Basically, it's because there is some tax differences. So it's always inefficient to do something like this. But again, we are in a perfect capital market without taxes. So maybe in this hypothetical perfect world, a firm can do this. So let's see what will happen if the firm pays a higher dividend by issuing some equities. So let's see how the firm's share price will change. Well, you can guess it, right? Share price should stay the same. Let's verify this. So basically we know that share price is 42, right? And then the firm wants to raise $28 million. So let me write this down. So firm raises $28 million at share price of $42. So basically now you can see how many shares the firm can sell. So number of shares the firm needs to sell will be given by 28 divided by 42, which is 0.67 million shares. And then you can see that number of shares after this issuance would be given by the original number of shares plus the newly issued shares. So this gives you 0.67, right? And now let's do this valuation here. So again, let's draw out the timeline. Now what you can see here is the firm after issuing some new shares, the firm's number of shares will be higher, right? It will increase to 10.67 million shares. And we know that in the future, every year, the firm will generate $48 million. So you can see that in the future, the dividend per year will be smaller because now we have a larger number of shares. So, for example, in the 7th year, the dividend would be given by 48 divided by 10.67. So let me see, what is this? So we will have we will have $4.5. So you can see that we will have $4.50. And then we will always have this. So we'll always have this 4.05 in all those future years. And then we can value this firm's common dividend price, right? So the firm's common dividend price would be the dividend or the value of the dividend. Right? So it equals dividend plus 4.5 divided by 12%. Right? What is the amount of dividend? Well, it's just the amount of dividend is just $48 million divided by total number of shares. Because remember what the firm has done. The firm wanted to pay out $48 million. So the firm issued some new equity. And now the firm indeed has $48 million. However, the number of shares has increased from 10 to 10.67. So that's why dividend is given by this number. And 4.5 divided by 12% is essentially the discounted value of all those future dividends. So this again will give us 42. Right? So if we compare these three policies of paying out cash, we can see that in the end, the firm's share price is always the same, right? So what you can see here is there is a trade-off. So basically, if firm pays a higher dividend now, then its future dividend will be lower. For example, in the third case, the firm pays the highest dividend among three cases, right? You can see that in this case, the firm pays out $4.5 per share. And you can see that in the future, okay, let me change to a different color. You can see that in the future, from year 1 to year 2 and to the future, dividends will be lower, right? So this is a trade-off. That is, if the firm wants to pay a higher dividend today, then it will have to pay a lower dividend tomorrow. Why do we have this result? Because recall that in the third case, the firm issued some new equity. It raised some cash. So that's why we can see a higher initial dividend. However, since the firm has increased the number of shares, then in the future, you can see that in the future, the dividend will be smaller, simply because of higher number of shares. And then you could also see that for policy 2, share repurchase. So this is purely share repurchase. Essentially, it means there is no dividend. However, because share repurchase reduces the number of shares, then you can see that in the future, we will have higher dividend, right? And you can see that policy 1 is is sort of in the middle between policy 2 and 3, right? So we have this medium high dividend, and then in the end, future dividends are also medium high. Between dividends you can get under policy 2 and dividends you can get under policy 3. But you can see that despite these different trade-offs, in the end, the initial share price is always the same. It's always $42. So basically, this is just a application of theorem, right? So basically, we're having a perfect capital market. So you can see that how the firm, or what is the firm's choice of dividend, will not affect the firm's value, and it will also not affect the firm's initial share price. Okay, so you can see that we basically talked about some theoretical aspects of dividend policies, or the theoretical results of using dividend versus share repurchase to pay out cash back to shareholders. But you can see that generally we will want to move to a more realistic case, right? So now let's talk about the more realistic case. The central result is dividend has a tax disadvantage. And let's see. Okay, first, maybe let's think about taxes, right? So why dividend has a tax disadvantage? It's simple. It's really because generally government charges higher tax rate on dividend compared with capital gains. So generally when an investor is invest in equity, then the investor can get or can earn some returns through either dividend or capital gains. And by tax law, if the shareholder receives dividend, the shareholder will have to pay taxes. And if the shareholder sells her shares, and if capital gains are realized because the shareholder has sold her share, in this case, there will be capital gain taxes. And then, because dividends generally have higher taxes compared with capital gains, so you can see that from the tax perspective, shareholders should prefer share repurchase to dividends. The reason is because when there is a share repurchase, the shareholder can sell her shares back to the firm. And by selling her shares back, the investor could realize some capital gains. And because capital gains have lower tax rate, so shareholders should prefer share repurchase. Of course, this is just from tax perspective. Okay, now let's see the case in Canada. So this is really the old table we have seen in, from chapter 18. What you can see here is, now let's focus on this equity income column. And we have two kinds of equity income, right? We have capital gains and we have dividends. What you can see here is, let's focus on the average here. In Canada, the average capital gain tax rate for the highest income earner is about 22.37%. But the dividend tax rate is 26.97%. So you can see that there is about a 4.6% difference. So you can see that if you're a high income earner, this almost 5% actually means a lot of money, right? So if you're this individual investor, and if you pay this high tax, then you will prefer share repurchase. And we also have a table about the US, and you can see that from this historical perspective, right? Dividend generally, for most of the time, dividend has a higher tax compared with capital gains. And you can see that back in 1970s, the difference is really like ridiculous, right? Capital gains had a tax rate of 35%. Dividends had a tax rate of 70%. Right? So if you're the person who invested in 1970s, I'm sure that you will always want capital gains instead of dividends. Okay. So you can see how the firm will think about share repurchase So you can see that how the firm will think about share repurchase versus dividend, right? Because clearly investors, they care about share repurchase versus dividend. And if a firm tries to raise some fund from outside investors, then the firm should also care about dividend versus share repurchase, right? So clearly, if a firm raises money by issuing shares and then gives the money back to shareholders as a dividend, then you could see that this is a bad idea, because in this case, shareholders will be hurt because the tax rate on dividend is higher. In the end, shareholders will actually receive less than their initial investment. So let's see this very simple but interesting example here. So let's say a firm raises $10 million from shareholders, and the firm uses this cash to pay shareholders $10 million in dividends. Let's assume the dividend tax rate is 40% and capital gain tax rate is 15%. How much will shareholders receive after taxes? Now, you can see that, okay, maybe let me see how should I proceed with this. Okay, let's just start from dividend. So what you can see here is investors So investors will get a dividend of $10 million, right? So what you can see here is if the investor has $10 million dividend, and then the dividend tax would be given by 15%. No, sorry, it's not 15%. Would be given by 14% times $10 million, which would be $4 million, right? Now, let's think about the capital gain tax rate. Capital gain tax rate is 15%. Now, in this case, how could we use this 15% capital gain tax rate? Well, remember that in the previous lecture, we mentioned this basic result. That is, if the firm pays out $2 as the dividend, then the firm's share price will drop by $2. So this implies that if a firm pays out $10 million as dividends, then the total value of then the total value of the firm's equity will drop by $10 million, right? And in this case, you can see that there will be some capital loss. So the capital loss would be also $10 million. Again, this is because if the firm pays out $10 million as a dividend, then the firm's value of equity will drop exactly by $10 million. And this drop will generate a capital loss from shareholders' perspective. The idea is like this. Let's say you bought Google at $100. And then after 2 months, you sold Google at $80. In this case, you will have a capital loss of $20. And this capital loss of $20 can be used to offset capital gains. So you can see that from tax perspective, this $20 capital loss can serve as a tax shield, right? So you can see that in this example, we have the similar result here. Investors will suffer from a $10 million capital loss. So there will be a tax shield from this $10 million loss. Now, what is the amount of tax shield? Well, we have learned about tax shield in previous chapters, right? When we talked about the interest tax shield, right? And in that case, we know that when you're calculating tax shield, you will use your interest payment times corporate tax rate. In this case, we're thinking about tax shield from capital loss. So in this case, tax shield should be calculated as capital loss times capital gain tax rate. Right? So tax shield would be 10 times 15, which is 1.5. So if you think about cash flow, right? So you have to pay this you have to pay this $4 million as your tax, so you have cash outflow. And then you get this $1.5 million of tax shield from capital loss. So in the end, you will get a net loss, which is minus $2.5 million. Essentially, you can see that this problem tells you that if the firm first raises $10 million from shareholders, then pays out this $10 million to shareholders. In this case, or through this process, shareholders, they will lose $2.5 million simply because of the tax rate difference in dividend and capital gain. Right? Okay. So you can see that from the perspective of tax, essentially, if a firm wants to return some cash to its shareholders, then the firm should use share repurchase, right? In this case, shareholders will get capital gains and they will pay lower taxes. So you can see that because shareholders, they like higher cash flows. So if a firm uses share repurchases, then this will actually increase the value of the firm. So if you think about a firm's optimal dividend policy, then it's actually really simple, right? At least theoretically, a firm should never pay dividends. If a firm wants to return some cash back to its shareholders, then the firm should only use share repurchase, right? However, you can see that if you look at data, then firms, they're actually issue dividends, despite dividends have tax disadvantage. So this is called dividend puzzle. That is, theoretically, from tax perspective, firms should never pay dividends. But in reality, firms, they continue to pay dividends. So let's see some interesting data. So this one is from 1975 to 2010. And it's for US firms. The vertical axis gives you the percentage of firms who are paying dividends and doing this share repurchase. So you can see that the red curve, right, gives you firms paying dividends, and the blue curve gives you firms repurchasing shares. What you can see here is, first, the firms paying dividends always have a larger percentage compared with firms repurchasing shares, right? So you can see that there's about 30% of firms who purchase shares like every year. And then in the beginning, you can see that during 1970s, over 70% of firms are paying dividends. Of course, for more recent years, the percentage of firms paying dividends has reduced. But you can see that still there are still a lot of firms paying dividends. And to be more specific, you can see that the percentage of firms paying dividends is always consistently larger than the percentage of firms doing the share repurchase, right? So this is pretty interesting. This is pretty much against our theory, because theory tells us a firm should never pay dividend, right? And we could also see this second picture, which tells us the composition of shareholder payouts. So what you can see here is the vertical axis basically gives you the value of share repurchase, right? So this is denoted in percentage of total payouts. For example, if you look at this point, it basically says that if a firm returns $100 to its shareholders, then $70 are in the form of share repurchase, and then the other $30 are in the form of dividends. So you can see that from 1975 to 2010, the percentage of total payouts in the form of share repurchase has increased a lot, right? From almost 5% in 1975 to over 50% in more recent years. Right? But still, you can see that there are still about 20 or 30% of total payouts are in the form of dividends, right? So we want to ask why. Why do we have this result? Well, we will actually still explain this from the tax perspective. The reason is because generally, or on the surface, it seems like the tax rate on capital gains is always lower than dividend. So we should always prefer share repurchase to dividends. But in fact, tax is complicated matter. And investors, they pay different tax rates because of their differences in income, or where they live, or their account type. For example, if you're in Canada, right, you would be able to have this so-called TFSA, right? As long as you have a job, you can open a TFSA investment account. So what is TFSA? It's tax-free saving account. Right? And if you make investment in this account, then it is completely free of tax, right? So if you get $1 of dividend or you get $1 of capital gains in this tax-free account, tax does not matter because $1 will always be $1. There's no tax. So in this case, you can see that at least you will not prefer share repurchase to dividends, right? And you can imagine that if you like to get some cash income, then possibly you will like or you will prefer a dividend to share repurchase, right? Okay. So in the end, you can see that investors' preference for share repurchase or dividends really depends on the difference between the dividend tax rate and capital gain tax rate. So here we define effective dividend tax rate. It's the combination of dividend and capital gain taxes. Okay, let's first define this effective dividend tax rate. So let's say you're considering buying a share just before the ex-dividend date, and you would sell this share after this ex-dividend date. So this scenario is like this. If this is the ex-dividend date, right? So you will buy here and you will sell here. Now let's think about your profit, right? So because you bought this share before the ex-dividend date, then you will be able to get the dividend. So basically you will get this dividend. However, there is a dividend tax. So your after-tax dividend would be dividend times 1 minus the dividend tax rate. Here, TD denotes the dividend tax rate. However, you will suffer from this capital loss. The reason is because we have learned if the firm pays out dividend, its share price will drop by the amount of the dividend. So this drop in share price will generate capital loss. Now you can see that you will suffer from this capital loss, right? That is, you make the purchase at the price of common dividend price, and when you sell, you will sell at the ex-dividend price, right? And then again, your after-tax loss is given by the loss times 1 minus TG. Here, TG is the capital gain tax rate. And if we assume the market satisfies the no arbitrage condition, then this should be equal to 0, right? That is, if there is no arbitrage, this left-hand side should be the same as the right-hand side, right? Why? What's the argument here? Well, you can think about this. Let's say if the market satisfies no arbitrage condition. However, this equality does not hold. Let's say we have this. No, you can't imagine what will happen. In this case, if the left-hand side is smaller than the right-hand side, this implies if you buy at the this means if you buy at the common dividend price and sell at the X dividend price, then you will have some positive profit, right? Because investors understand doing this transaction will have the positive profit. What they will do is they will rush to make the purchase before the X dividend date. Then this will push up this PCUM, right? This will push up the firm's common dividend share price. So this implies the left-hand side will increase. And then this inequality will disappear. In the end, we will have this equality. And by the same reasoning, you can actually make the similar argument. Let's say we have a inequality sign like this. In this case, you can see that make the purchase before the X dividend date and sell the share after the X dividend date will give you a loss, right? So this would be smaller than 0. In this case, you can see that nobody will want to buy this share before the X dividend date. To be more specific, they will rush to sell this share before the X dividend date. This will basically push down this PCUM, right? So this common dividend price will be pushed down because of this selling from shareholders. So in the end, the left-hand side will be smaller. So we will again have this equality sign, right? Okay. Now, after getting this no arbitrage result, we can finally define the effective dividend tax rate. So what we will see here is it's really a very simple mathematical manipulation. So you can find out PCUM minus PEX times 1 minus the capital gain tax rate equals dividend times 1 minus the dividend tax rate. So this implies the following result, right? And obviously you can see that this can be further simplified, right? And then this would be, okay, I will not waste time to write these formula here because we have exactly the same one on this lecture note. So you can see that you will have this. And then we would define this guy as the effective dividend tax rate, right? So basically the effective dividend tax rate is given by the actual dividend tax rate minus the actual capital gain tax rate divided by 1 minus this capital gain tax rate. And you can see that this effective dividend tax rate measures the additional tax paid by the investor per dollar of after-tax capital gains income that is instead received as a dividend. Well, this is a very long sentence and it sounds very confusing. But let's use some numbers here. So let's say the dividend is 1, right? And let's say the effective dividend tax rate is, let me just write down some random number. It's 10%. And then you can see that this X dividend price, X dividend price minus, So you can see here that the common dividend price minus the X dividend price is given by 0.9, right? So essentially you can see that it basically means that from the tax perspective, from the investor's tax perspective. Receiving $1 of dividend is the same as receiving $0.9 of capital gains, right? Again, the reason is because the tax rate on dividend is higher. So even you're receiving a higher amount of cash from dividend because you have $1, but still, from this after-tax perspective, $1 of dividend is essentially the same as $0.9 of capital gains. Okay, now let's look at this really simple problem. So it says, according to EY, the marginal tax rate for a Ontario investor in the highest tax category were 23.21% for capital gains and 31.34% for dividends. In 2013, the same investor would face a marginal tax rate of 24.76% for capital gains and 33.85% for dividends. So what was the effective dividend tax rate for this investor in 2003, and how the effective dividend tax rate changed in 2013? So for 2003, we just obviously plug in numbers. So you can see that it's 31.34% minus 23.21% divided by 1 minus 23.1%. Right? So this gives you a number of 0.59%. Then for 2013, it's similar. Right? Just plug in numbers. Then this would give you 33.85% minus 24.76%, 1 minus 24.76%. So this gives you 12.8%. Right? So we can see that the effective tax rate of dividend has increased from 2003 to 2013. Now let's talk about Cleantail Effect. So basically you can see that we have discussed this. That is, different investors will have different preferences over dividend policies. The reason is because obviously they have different tax rates in capital gains and in dividends. So you can imagine that investors, if this investor has to pay higher tax on dividend, then this investor will prefer share repurchase to receiving dividends. However, if an investor does not pay tax in her investment account, in this case, potentially, this investor could have some preference over dividends, right? So this investor will prefer dividend to share repurchase. And then we also need to consider firms as investors. Generally, if a firm holds preferred shares from other firms, then dividend income from these preferred shares is tax deductible. So in this case, you can see that from corporations' perspective, these corporations, they will prefer dividends, right? So you can see that these differences in tax rates and these differences in tax preferences will create the so-called Cleantail effect That is, the dividend policy of a firm will be optimized for the tax preference of its investor clientele, right? So basically you can see that when a firm is thinking about the choice of share repurchase versus dividends, then it will think about its investors. So it will consider how many investors there are actually tax-free investors. How many investors are actually corporations? So in the end, it will try to choose the optimal way of paying its cash back to its investors according to investors' tax preferences. So let's see this table, and this is a table from Federal Reserve, which tells you the percentage of different kinds of investors. So you can see that we have this first type of investors, individuals, right? And generally, these individuals, they will prefer share repurchase. And the percentage is 52%. Then the second type of investors are institutions, pension funds, retirement accounts. These accounts are generally tax free. So you can see that in this case, there is no tax preference from this type of investors. And generally this type of investors, they will prefer some cash income. So in this case, they will actually prefer dividend. And then we also have corporations as investors. As I said, if these firms hold other firms' preferred shares, then the dividends they receive from other firms is tax deductible, right? So from these firms' perspective, there is tax advantage for dividends. So basically you can see that if you look at these numbers, basically you can see that for about 52% of investors, then dividends have disadvantage. But then for 48% of investors, dividends actually have some advantage over share repurchase. So you can see that it's almost a 50-50 case, right? So that's why in reality, you can see that firms are doing both. Firms are doing share repurchase, and firms are also paying dividends every quarter. Okay. So if we look at data, we can actually see that data actually shows there is this important Cleantail effect. So for example, this research in 2003 shows that in 1996, right, individual investors held 54% of all shares by market value. However, they only receive 35% of all dividends, right? So basically you can see that investors, they actually try to hold equity with low dividend yield, right? Because it's 54% of market value, but they only receive 35% of dividends, right? So this is a interesting finding. Okay, another observation is based on this dividend capture theory. So basically, you can imagine that if there is a dividend coming up, then investors, right? Investors who is in high tax category will try to sell shares before this X dividend day. And then low tax investors will want to buy this share before this X dividend day, right? So if I draw this timeline here, again, we have this X dividend day. Then you can see that high tax investors will sell, right? Because they don't want to get the dividend. Because from their perspective, dividend is expensive. It has a higher tax rate. However, low tax or tax-free investors, they will buy because they wanted to get this dividend. They want to get this positive cash flow, right? So basically, this implies that we should see large trading volume before this X dividend day, right? So that's the prediction here. And then if you look at data, so it's really a case study here. So this is a picture based on a specific firm, Value Line's special dividend. Right? What you can see here is there was a special dividend of $17.5. And you can see that this is a very large dividend. And then what you can see here is this is essentially the X dividend. Oh, sorry, it's not X dividend date. So on this date, the firm, right, announces this large dividend. So this is essentially a announcement date. And after the firm says it wants to pay this $17.50 large dividend, you can see that the transaction volume through May was generally very high, right? So you can see that after this X dividend date, this is the X dividend date. After this X dividend date, transaction volume became much smaller, right? So you can see that the observation we can see here from this value line firm is consistent with this dividend capture theory. Okay, now let me talk a little bit about signaling. We discussed signaling in previous chapters, right? So in the previous chapter, we said debt can serve as this signaling device. So basically, the story there was if a firm has a good project or if a firm has good prospect, then the firm can afford to use high leverage. So this basically implies if investors find out a firm is using high leverage, then investors will consider this firm as a good firm. And here we are talking about signaling with payout. And then we will mainly focus on the so-called dividend smoothing policy here. So this is really a empirical observation we have seen from data. So basically, if you look at data, most firms, they will use a a so-called dividend smoothing policy. Basically, it means that these firms, their dividends are very consistent, right? So if you look at data from 1971 to 2001, only 5.4% of dividend changes were decreases. That is, a firm generally will just want to increase dividends, and a firm will generally not want to reduce dividend. So this is a case from General Motors. What you can see here is, first, for these red lines, we can see red lines represents earnings. So these are General Motors earnings. And then these blue lines represents dividends. Okay, let me use a blue color. So these blue lines represents General Motors dividends. What you can see here is GM's earnings are really volatile, right? You can see that on a good year, then the dollars per share would be about $2 to $3. And on a bad year, it's below -$5. So this is a range larger than $8, right? So it's very volatile. But what you can see here is the dividend is quite constant, right? I mean, it's not exactly constant, but you can see that it's very smooth, right? It only changes for 5 times over 30 years, right? So firm does not change dividends a lot. Now, why do we see this kind of result? This is actually a very drastic result because you can see that earnings are so volatile, but dividends are so calm and so constant, right? Well, the argument is management. They believe that investors prefer this stable and constant dividends with this sustained growth rate. So management will want to maintain a long-term target level of dividends as a fraction of earnings. That is basically, this argument says investors like constant dividends. So firm will try its best to pay this constant dividends to investors. Okay, let me see whether I want to talk about this. Okay, I have 6 minutes. Okay, I'll end this class here. So we will talk about this signaling in the next class.